Everyone, it's James Dainard, and welcome to On the Market YouTube channel presented by Fundrise. Today we're going to dive into reverse 1031 exchanges.
Only problem, I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money. So what is a reverse 1031 exchange? Before we dive into that, we're going to talk about what a regular 1031 exchange is. In a simple form, you're selling an investment property to buy a new investment property. The 1031 exchange allows you to defer those taxes in the gain of your first property. The tax deferment gives you a larger down payment because you don't have to pay the tax man your portion of the taxes and apply it towards your new property. It's a way to expedite and grow your portfolio dramatically. For more information about this, check out my video on bigger pockets and it will break down the whole 1031 exchange process. The 1031 exchange can be one of the best tools to grow your portfolio dramatically in a short amount of period of time. But what's the downfalls? The downfalls is you have to work off a very tight window. The government says when you go to do a 1031 exchange, once you list that property and it sells and it closes, you have to identify your new replacement property within 45 days of selling your first property. Not only that, you have to close that property within 120 days of closing. So this gives you a very tight window to work inside and out of. One of the great things about a 1031 exchange is you can sell a property that's maximized out on equity and go find something with more opportunity. But when you're inside of a tight time frame, it allows you you have to move a lot quicker and you might not be able to find that great deal to relocate into. These tight time frame is the whole purpose of using a reverse 1031 exchange. What it does is it allows me to go find that really good deal or my next property that I want to purchase. I can actually purchase that property and lock it in before I actually sell my first investment. It allows me to avoid those tight time frames and buy something that I don't really want down the road. The last thing I want to do is have a lot of appreciation and that I just crushed a deal for me to sell it and reload it into something I don't really want. So reverse 1031 can be complex and there's a lot of moving parts. Remember, it's a lot different than a regular 1031 exchange. The 1031 exchange is a simpler process because you're selling a property, you're reloading it into a new one, and the exchanger handles the whole process for you. In addition to, you can get conventional financing and handle it like a traditional purchase. With a reverse 1031 exchange, there's a lot more steps in there that you have to follow so you don't lose that tax deferment. Make sure you do the right steps or you might sell off that asset or buy that property and still get hit with that tax liability. So follow the rules and regulations. So the steps I take before making that decision to do a 1031 exchange or a reverse 1031 exchange is I look at my portfolio. I look at, do I have any properties in there that I feel are maxed out? Did they get that sudden huge equity pop? Did the rents already jump dramatically? And am I moving into more standard appreciation and standard rental increases? If it is going into a more standard investment return, I don't really like standard and I'm going to look at trading it out for something better. So once I sell off one of those assets and made the decision to trade out into a new property, I then can utilize a reverse 1031 exchange to go shopping first before I even sell that first property. And this is why reverse 1031 exchanges are so helpful. We are in a very hot real estate market. Inventory is at all-time lows. It is very competitive out there. If I'm going to a seller and I'm saying, hey, I want to buy your property, but before I do that, I need to be contingent on selling my other rental property and then doing a 1031 exchange to buy yours, it's not going to look that attractive in a really hot market. I want to be able to for me to get a good deal, I need to come in with aggressive offer terms. I still need to be able to offer like I would on a fix and flip property or a BRRRR property. The reverse 1031 exchange allows me to do that. I can go and make the decision to buy before I even sell that property. I can put together mailing campaigns to find that next property that I really want, not just what comes in front of me. I can talk to all my local wholesalers to let them know what I want and to go find it for me. In addition to, I can still write offers on market properties because I can still move forward with the closing rather than have to give them a contingent offer of me selling this other property. The great thing about a reverse 1031 exchange is you don't have that 45-day pressure window, so you can go find the perfect property to upleg into before you go through the sale of that property. Once you find that property, you then close on it in the name of your 1031 exchanger or the new entity that they put up. You close on the property and then you want to start marketing and selling that upleg asset to backfill you in. So the downside of a reverse 1031 exchange is usually liquidity. In a normal 1031 exchange, I'm selling this property, I'm taking the proceeds, and I'm applying it to my next property that I'm purchasing on. In a reverse, I have to come up with that down payment to close that property as I'm waiting for that sale to commence. It is really important as soon as I find that property to purchase, I'm going to start marketing and selling that other rental property because it's going to reduce the amount of cash I have to come out for a certain amount of time. And at the same time, I want to get that transaction to close through. So once I close on this property with the reverse 1031 exchange, I am marketing my upleg property and getting it ready to sell. Once that property sells is when the reverse 1031 exchange starts to complete. That property closes, the exchanger then deeds the property to me, and at the same time, I'm then refinancing out of that non-recourse hard money loan into a conventional loan because now the property is titled in my name and the reverse 1031 exchange is complete. So the reverse 1031 exchange is a little bit more complex. It costs a little bit more. So why even do this whole process? The reason being is the reverse 1031 exchange can be the most beneficial tool for you to grow your portfolio exponentially. How we've grown our portfolio from 10 condo units to over 2,000 doors in the Seattle market is a lot of times is utilizing 1031 exchanges or reverse 1031 exchanges. Anytime I'm selling off an asset that I feel is maxed out on value or maxed out on rent, I want to relocate it into a property that has more upside in it, that can give me that huge equity pop like my first property did. The reverse 1031 exchange allows me to buy the way I like to buy, which is make a quick decision, get a strong offer out, and then close the property quickly. These terms can often get me the best possible deal. If I'm waiting on a contingent sale, it's going to make my offer weak, and I'm probably not going to get into that next upleg property to where I can create that huge equity position. So let's walk through a case study of what I just completed on a reverse 1031 exchange and why I did it for my portfolio. So 2 years ago, I purchased a duplex in the Queen Anne neighborhood of Seattle, Washington. It was a heavy fixer, had a huge equity position, but it was a lot of work to get it done. I paid $375,000 for this property. I then put in $125,000 into repairs with a total basis of around $500,000 on the property. The new appraised value was now $800,000, which gave me a $300,000 equity gain on the property. In addition to, I was cash flowing over $800 a month and got almost all my capital back. So why am I even selling this? After evaluating this duplex, I felt like it had its maxed out potential and I was going more into steady growth. Also, right now we're going through an economic transition. We're seeing higher inflation. We could be entering stagflation. So at this time, I want to start trading my properties around to where I can get into assets that I'm going to be comfortable holding for the next 5 years. So I made the decision to sell off that duplex and go find something else for my portfolio that I could get those massive equity upsides in again. So I contacted my local 1031 exchanger, I set up the paperwork, I got pre-qualified with in-trust funding so I could make a quick decision and close on the next potential property quickly, and I started shopping. I then located a triplex in Issaquah, Washington, which is located in the East Side neighborhood. So I went from transitioning from a really good neighborhood of Queen Anne in Seattle to the East Side. Why did I make the trade? Well, before I make any kind of 1031 exchange or reverse 1031 exchange, I'm committing to stay in a property for at least another 2 years. I want to track the trends. The East Side had been appreciating at nearly double what the Seattle area had been appreciating at. In addition to, rent increases were almost double from what it was for Seattle as well. So by doing this exchange into a market that's trending up, I can hyper accelerate my returns by following the right trends. In addition to, it was located on an 8,000 square foot lot zoned for townhomes. In the future, I can actually plan and permit 5 to 6 additional townhomes on this property, whereas my duplex that was kind of maxed out, I couldn't build anything on. So it had additional upside in there. I was getting a better location with stronger rent increases. I had higher appreciation, and it has versatility whether I wanted to keep it as a triplex or turn it into a development site down the road. So where am I at currently in this process? I've closed on the triplex in Issaquah. I had to have come up with about $250,000 down to close on that property. My duplex is currently pending on the market for $800,000. Once that property sells, I'm going to take the proceeds, which is going to be right about my down payment for the Issaquah property of about $250,000. The exchanger is going to deed that property to me at that point, and I'm going to refinance that into a conforming loan and backfill all of my initial down payment back to me. Once the exchange is all complete, I'm going to be cash flowing about $1,000 a month, $200 more than I was on the duplex, and at the same time, I'm going to start working on obtaining permits for the townhome site for down the road, which is is going to give me a value increase of at least $500,000 on this property. So as you can see, this trade can make a drastic increase in my portfolio. I'm making roughly $2,400 more a year by just doing the trade at that point. I have a huge equity upside, and I have a $500,000 potential equity kicker down the road. If I would have just been content with hanging on to my duplex and making my $800 a month, there's nothing wrong with that. But I always want to do better. So as you're looking at upgrading your portfolio, increasing your position, make sure you're utilizing all the different tools. 1031 exchanges, reverse 1031 exchanges. Go find your exchangers and your lenders that can work with you and put your plan in place. Thanks for tuning in about reverse 1031 exchanges on the On the Market YouTube channel presented by Fundrise. For more investing tips, check me out on YouTube at Project RE or Instagram JDaneFlips.